Okay, I want you to picture the scariest moment in the economy. What do you see?
Oh, that's easy. It's chaos, right?
Yeah, panic on the trading floor, red arrows just plummeting down, news anchors shouting about a recession.
Absolutely. We are wired to see danger in the fire, in the screaming, the bankruptcy headlines. That's what a crisis looks like.
But the whole premise we're exploring today argues that we're looking in completely the wrong direction.
Uh-huh.
It suggests that the most dangerous moment isn't when all the alarms are blaring. It's when they've been silent for so long that we've, forgotten they even exist.
That's the paradox of what you could call the danger zone. According to Hyman Minsky, the economist we're getting into today, the moment of maximum risk is. It's actually the moment of maximum perfection.
Perfection. How?
It's when balance sheets look pristine, bankruptcies are at historic lows, and everyone from the Federal Reserve down to your neighbor thinks, we finally figured it out.
It's that seduction of stability. So today we're going to look at why a stable economy isn't just a happy accident. It might actually be the fuel for the next explosion.
And this isn't some fringe theory from a TikTok influencer.
Right. This is an idea that was ignored for decades until the 2008 global financial crisis basically proved it right in real time.
It's the financial instability hypothesis. And frankly, it's one of the most unsettling ideas in economics because it says the system doesn't break because something went wrong. It breaks because things went right for too long.
So let's talk about the architect of all this anxiety, Hyman Minsky. For a guy whose name is now synonymous with market crashes.
The Minsky Moment.
Exactly. He was pretty much the wallflower of 20th century economics, wasn't he?
Wallflower is being kind. He was practically a heretic. You have to understand the context of mid-20th century, the academic world was dominated by this neoclassical synthesis.
The idea that markets are fundamentally efficient and rational.
And equilibrium seeking. The prevailing belief was if you just leave the market alone, it finds balance.
Right, like the economy is a pendulum. You can push it, it might swing for a bit, but it always wants to return to the center.
Minsky looked at that pendulum model and basically said, have you met a human being? Have you ever seen a banker with a year-end bonus on the line?
Huh, right.
He argued the financial system isn't a pendulum seeking balance. It's more like an unstable explosive that builds up pressure from the inside. But in that booming post-war era, nobody wanted to hear the guy in the corner mumbling about doom.
It's the Cassandra curse, isn't it? If the economy is booming and you're the one person saying this stability is a trap, you don't get invited to the policy meetings.
You certainly don't get the top jobs at the big universities, and that went on for decades.
Until 2008 happened.
Exactly. The Great Moderation, that long period of low volatility from the mid-'80s to 2007, ended in the most spectacular collapse since the Great Depression. And the standard models, they just couldn't explain it.
They were all looking for an external shock, right? A war, an oil crisis.
Something from the outside, but there wasn't one. The housing market just imploded on itself.
And suddenly, everyone is dusting off these old papers from the 70s and realizing Minsky had drawn the blueprints for the catastrophe 30 years before it happened.
And that's when the Minsky moment really entered the public lexicon. It's that sudden, violent collapse of asset values.
But the key part of his theory is that the collapse is endogenous.
Meaning it comes from the inside.
It's a feature, not a bug.
The crash is baked directly into the boom.
Okay, let's get into the mechanics of this, because stability breeds instability is a great headline, but the actual mechanism is, it's fascinatingly psychological. It starts with memory, or really the lack of it.
Think about risk perception. If you're a bank manager and for 5 straight years, every single loan you've issued has been paid back on time.
And every asset I bet on has gone up in value.
What does your risk model tell you?
It tells me risk is zero. It tells me I'm a genius.
And it tells you that you are leaving money on the table. If the world is this safe, holding cash is stupid. Being conservative is a dereliction of duty to your shareholders.
So you don't just stay the course, you adapt to the safety. You lower your lending standards. You increase your leverage.
It's the success breeds excess trap. It's not that people suddenly become these greedy villains. They're just rational actors responding to a signal of absolute safety.
Right. It's like if the speed limit is 65, but you've driven 90 for a whole year and never seen a cop or a crash, well, then 90 becomes the new baseline.
And then 95 feels safe, and then 100. Minsky's genius was that he categorized this drift. He didn't just say people get risky. He broke down the financing of an economy into 3 distinct stages. It's almost an evolutionary chart of a bubble.
Okay, let's walk through these phases. I think this is probably the most useful framework for anyone trying to figure out where we might be in the cycle right now. So we start with the boring part, hedge finance.
Phase 1. This is the bedrock. So imagine a manufacturing company. Let's call it Solidcore. Solidcore takes out a loan to build a new factory. Their cash flow from selling widgets is more than enough to pay the interest on that loan and pay down the principal every month.
So this is just traditional sound banking. I borrow $1 million, I make enough money to pay back that $1 million plus the interest. My debt actually decreases over time.
It's self-liquidating. If the economy hits a little bump, say sales drop 10%, Solidcore is fine. They have a buffer. The whole system is robust because debt is tied to actual income production.
But Minsky says we can't stay here. Why not?
Because Solidcore looks at their competitor next door who is suddenly growing way faster.
And that brings us to phase 2.
Enter phase 2, speculative finance. This is the transition zone. Confidence is high, interest rates are usually pretty low or stable, so a new player comes in, let's call them Growth Co. They borrow money to expand, but they borrow aggressively.
Okay.
Their cash flow is enough to pay the interest on the debt. but not the principal.
So they're just treading water, they're servicing the debt, but the actual pile of debt isn't getting any smaller.
Not at all. In fact, when the loan comes due, they can't pay it off. They have to roll it over, take out a new loan just to pay off the old one.
That sounds incredibly common. I mean, in the corporate world, in government debt, that's just business as usual, isn't it?
It is standard operating procedure for many sectors, and it works perfectly fine as long as the music keeps playing. As long as banks are willing to lend and interest rates don't spike, Growth Co. looks like a juggernaut.
They're expanding faster than Solid Core because they're using all that leverage.
And the market rewards them for it. Solid Core starts to look like a dinosaur. Growth Co. is the new darling of Wall Street.
Which, of course, forces Solid Core to start acting more like Growth Co.
Yeah.
Just to keep up.
The infection spreads, and then the cycle matures. The good times have been rolling for years. Asset prices, stocks, real estate, you name it, they're all soaring. And this gives birth to phase 3.
Ponzi finance.
The name says it all. We're deep in bubble territory now.
What defines a Ponzi unit?
In a Ponzi unit, the borrower has taken on so much debt that their cash flow covers neither the principal nor the interest.
Wait, hold on. If I can't even pay the interest, I'm technically insolvent from day one? How does a bank even approve that loan?
Because the bank isn't looking at your cash flow anymore. They are looking at the asset's value.
Ah.
You're borrowing to buy an apartment building, not because the rent will cover the mortgage, but because you and the bank both believe the building will be worth 20% more next year. You're betting everything on capital appreciation.
The greater fool theory. I don't need to make a profit from the asset itself. I just need to sell it to someone else for more than I paid.
You're no longer investing. You're just riding the momentum. And Minsky argued that at this stage, the economy has completely decoupled from reality. It's no longer about production or income. It's a financial game. The stability of the borrower depends entirely on the stability of the asset market.
And this is the peak of what he called the Minsky cycle.
Yeah.
The economy is full of these Ponzi units, households flipping condos, companies buying back their own stock with borrowed money, and it all looks magnificent on paper.
Because asset prices are sky high. GDP is up, net worth is up, everyone feels rich, but the fragility is absolute.
What do you mean?
Well, back in the hedge phase, you needed a massive disaster to break the system. In the Ponzi phase, what do you need to trigger a total collapse?
Something big.
Nothing.
Nothing.
You just need prices to stop rising. They don't even have to fall. If the real estate market just goes flat, the Ponzi borrower can't refinance. They can't sell at a profit. They can't pay the interest. They're forced to sell immediately just to cover the loan.
And when all the Ponzi units rush for the exit at the exact same time?
Liquidity just vanishes.
Yeah.
Prices crater. The collateral that was backing all those loans becomes worthless. Then the banks panic and they stop lending to everyone, even the good, honest hedge borrowers. The whole house of cards comes down.
That's the Minsky moment.
That's the Minsky moment.
It's terrifying because it implies the crash isn't caused by a specific bad policy or some evil banker. It's caused by the rational pursuit of profit during a long, stable period. The stability itself created the Ponzi phase.
It also creates a huge philosophical problem for regulators. I mean, if you're a central banker, your whole job is to maintain stability.
Right.
But Minsky is telling you that by smoothing out the business cycle, by preventing small recessions, by bailing out a Bear Stearns, you might just be validating the Ponzi players. You're teaching them there are no consequences.
You're essentially telling the market, don't worry, we won't let you fail.
Yeah.
Which just encourages more of that phase 3 behavior.
This is the deep Minsky paradox of policy. The better a government is at preventing crises in the short term, the bigger the eventual crisis becomes in the long term.
You're just allowing the dry tinder to pile up in the forest. You stop all the small brush fires, so when the big one finally hits, it burns the whole continent down.
That's the perfect analogy.
So let's apply this to the modern landscape, because we see these patterns repeating over and over, don't we? It's almost like we have collective amnesia every 10 or 15 years.
We absolutely do. Look at the post-2008 world. We had a massive crisis. We vowed to be safer, but what did we do? We had a decade of near zero interest rates. And what does a zero interest rate policy do? It forces everyone out of hedge finance. You can't make money sitting on cash. You have to speculate to get any kind of return.
So the cure for the last crisis essentially planted the seeds for the next one. We incentivized leverage because debt was dirt cheap.
And we saw it everywhere. From the crypto boom to the explosion of SPACs to the real estate run-up post-2020, you saw classic Ponzi finance behavior, people buying assets with no underlying cash flow solely because number go up.
There's a psychological part to this that I think is crucial. Minsky talks about the narrative of invincibility. In every single cycle, there's a story we tell ourselves to justify why the old rules don't apply anymore.
The internet changes everything.
Housing never goes down nationwide.
This time is different. Those 4 words are the siren song of the Ponzi phase. When you hear serious people arguing that valuation metrics like price-to-earnings ratios don't matter, or that debt to GDP is an irrelevant statistic, you're watching the Minsky cycle happen in real time.
It's so interesting because Minsky really frames this as a tragedy, not a crime story.
It is.
It's tragic because the participants often don't even realize they've crossed the line from speculative to Ponzi until it's way too late.
Most people don't wake up and say, you know what, I'm going to destabilize the global economy today. They say, I need to keep my job, or I have to get my kid into college, and my house is my only real asset. The system itself compels them to participate in building the fragility.
If you sit out the boom, you look like a fool. You underperform, you get fired.
Exactly. So standing on the sidelines during a Ponzi phase requires an immense amount of discipline and a willingness to look stupid for a really long time.
As the famous saying goes, the market can remain irrational longer than you can remain solvent.
Minsky knew this. He knew that the herd mentality is a survival mechanism. But the deep irony is, by sticking with the herd for safety, we all end up marching off the cliff together.
So if we accept that this cycle is, well, maybe inevitable, that stability will always breed instability, what do we do with that information? As a listener trying to navigate a career or investments, what's the takeaway?
I think it's about pattern recognition. You stop looking for the spark that causes the fire, the assassination, the election, the trade war. Those are just triggers. You start looking at the fuel load.
You ask, how much leverage is in the system?
Are people buying assets for the income they produce or purely for price appreciation? You look at the quality of the debt, not just the quantity.
It's like for the silence.
You look for the silence.
Yeah.
If volatility has been incredibly low for years, if credit spreads are razor thin, if every single expert agrees the outlook is sunny, that is your signal to be defensive.
That is such a hard mental shift to make. We want to celebrate the calm. We want to believe the soft landing is real and permanent, but Minsky forces us to be suspicious of the calm itself.
It's about understanding that the economy breathes. It inhales confidence and debt, and it exhales fear and liquidation. You can't stop the breathing, but you can at least try not to get crushed when the exhale happens.
It also completely changes how you view government intervention. When the Fed steps in to save the day, half the market cheers. But through a Minsky lens, you have to ask, are they fixing the problem, or are they just validating the Ponzi finance and ensuring the next crash is even worse?
And that is the huge ongoing debate. Minsky would argue we need a regulatory system that is inherently skeptical of boom times. Regulators who take away the punch bowl just as the party is getting good.
But politically, that's almost impossible to do.
Nobody gets reelected for slowing down an economic boom. So the cycle continues.
So we've covered the three phases, the inevitable crash. It's a sobering theory, but I think a really necessary one. It strips away the illusion that we can master the economy like some machine.
It reminds us it's a human system, driven by human flaws. And human optimism, which is both our greatest strength and our greatest weakness.
As we wrap this up, I want to leave you with a thought to carry around this week. We are constantly bombarded with news about what's going wrong in the world. But if Minsky is right, the most dangerous thing in the economy today isn't a visible crisis. It isn't a headline, it's the illusion of stability. So the next time you look at a market that seems too good to be true or a trend that feels effortless, ask yourself, is this stability? Or is it just the quiet before the Minsky moment?
Stay skeptical.
That's it for this deep dive. We'll see you in the next cycle. Thanks for listening.